Hey everyone, Assalamu alaikum. Thanks for joining on to the webinar. It's an interesting one, and I wanted to bring forward to the group. And thanks to Tarish Bhai and others who have made this possible. I wanted to introduce to us Mr. Syed Nishat, and he's a fiduciary financial advisor and a partner at the Wall Street Alliance Group, one of the well-renowned folks in that community, and he has had several interviews through the media outlets on Forbes and Kevin MD and US News, Investment News. The point of today's webinar is to uh, basically bring forward, the nitty-gritty things that we could do. Yes, investing, can we invest through a company? Can we invest through a big hedge fund? Can we invest through partners? Can we invest independently? But just wanted to share because everyone's experiences have been different. We wanted to bring this as a Q&A, and I thank you for all those who have sent in the questions. So I'll start the Q&A session, but also a disclaimer that number one, the session is being recorded. So that's the first disclaimer. The second one is anything that's discussed over here is for purely educational purposes, and no one is held liable for any investments that you would do or have any losses. Investments obviously needs to be done through your own risk and through your own financial advisor. Okay, so we'll get started. The first one I had, the question that came, and I'll start with the one that brother sent me just recently, is someone who has had a 401k at a previous job, and then he has moved to a new job. What are his options? How can he convert? How can he move that 401k from the previous job to this job and make everything under one umbrella? And that's number one. Number two is, will he have a choice to invest in his stocks of choice or ETFs of choice, or would he have to be, is he restricted by any certain laws?
Yeah, first of all, thank you, Dr. Haseeb, for inviting us. We really appreciate it. And today's webinar will be fun because if you see, Dr. Haseeb wanted to have the webinar titled How to Do Everything, the Investment by Yourself without a financial advisor. And he actually called a financial advisor to say that. So it will be fun. So we are a fiduciary financial advisor. The word fiduciary is important because there's no product, nothing. This is something that we are very proud of. And I think any financial advisor that you use, make sure you ask the question that are they really a fiduciary? So having said that, the first important question that Dr. Haseeb asked, that if you have left a job and you have old 401k, what options do you have? Number one option, you can continue to be there in the old 401k and money can stay invested. Usually what happens in the 401k, the investment options are limited. You can just buy within that, but there's no obligation, didn't you have to take it out. Second option is they can roll over the money to an IRA account. And once you roll over the money to an IRA account in the individual name, you can open the account like Schwab or TD Ameritrade, wherever you want to. And the money you have an option to invest however you want to. Now, what are the disadvantages of doing it? One advantage of keeping it in the 401k, usually the costs are very low. That's a fact. So if you want to just keep it there, low cost usually, and the money grows usually as long as you have a good mutual fund. But if you move it, if you go to an advisor, there's a fees involved into it. And sometimes, you get into a trap of buying bad investment. And that may be counterproductive. So as long as you are investment savvy, you know how to invest or have a good financial advisor, if you want investment options like buying stocks, mutual funds, ETF better, it may be prudent to move it to an IRA account. But the choice is yours. Speak to your financial advisor, sit down with your accountant, and there's no tax consequences to move it from trustee to trustee.
Excellent, excellent. And then so what I understand is you could move it and they can open the IRA by themselves, right? They can just go to Schwab or Fidelity and just click on open an IRA account and they can.
Yeah, absolutely. Absolutely.
Wonderful. Now, if again, I'm just taking this one step ahead. If no one has time and they say, you know what, they just call you and say, hey, Syed, can you just, assign someone, take care of everything. Just that's it. Because, I'm a busy guy. I don't have time in my practice to sit and open an account, decide what stocks to pick. And if you have a certain, aggressive portfolio or a short-term, mid-term, depending on how you want to be, how I want to invest, then I could just call you and do we have that option? And if so, what is the fees? That is another question.
Yeah, so usually whenever you use a financial advisor, there are the fees involved into it. Like for example, I'll give you my situation. In order to be our client, a typical fee is 1% per year to invest the money. So for example, if you invest, I'm giving a hypothetical number, $500,000. If you have a 401k, move it, is usually 1% per year to manage it. 1% of $500,000 is $5,000 per year. You don't pay upfront, you pay monthly. That means 5,000 divided by 12, which come out to be around close to $450. This is typically how a financial advisor charges. And as the asset goes, the fees goes down. What I mean by over $1 million, 0.9, over 2 million, 0.8. So the number one question to ask is the fee worth it to pay all of this? Can you do it yourself? So today's whole purpose of coming in, first try to avoid us, see if you can do it yourself.
Right, right. So thanks, because we have had talks through Amana and Azad investments. So some of our friends are invested through them. The rate that you quoted is the same. It's like a sliding scale. If you get to $1 million, then it's a little bit less, and they look at the entire portfolio.
Yeah.
Look at your 401, your IRA, your HSA, and if there's any SCS, the education savings plan, and all of that. So Azad does that. So we have a few friends who have kind of diversified. So that's good to know. Thank you.
Sure.
The question is, uh, this is going to be the election year. What would you give, like, what's the market outlook? Is it a good time for me, again, not as why just from the learning aspect, do you think it's a good time for me to, if I have cash, do I jump in now and buy a thing in the anticipation is going to go up further, or kind of hold off for some time?
Yeah. So one of the questions, like, physicians are asking or clients are asking during election year, what do we do? Should we sell everything? This is it actually happened, last election. A lot of people were saying, hey, you know what, Trump is coming, let's sell everything. It was kind of insane in a sense. A lot of people were, get emotional about which party is going to come into play. So we highly recommend, if you look at the statistic, this is statistics since 1964. I'm hovering my mouse all the way, until the last election. Market went up during election year, Dr. Haseeb, about 13 times off of 15 times. And a lot of people actually sold a lot of stocks during last election with the expectation that the market will collapse. But when Trump became president, market rally up. The election before last election I'm talking about. So it is very important. I recommend not to time the market. This year is the issue is not who's going to be the president. Actually, the issue is the interest rate. Inflation, that's the main thing. We believe, you can watch our interviews in CNVCs, that we believe that the market will be driven by Fed. The last year when we went to CNBC, the interest rate last year was about close to inflation 8%. We do see the projection of interest rate is going down, and Fed should be able to get it under control. Do not time the market, stay in. But the only problem is that the market went up this year too quickly. A lot of folks who don't know follow the market. The stock market in general, I'm talking about S&P 500, is up about 15% in about 6 months. I think this is insane. In that quick time, market went up. So if you're someone like you, young like you look young and sound young. I'm assuming you're young. So don't worry about it. In long term, you're good to go. The problem becomes like if you are close to retirement, or if your children are going to college in 1 year. So those funds. So the children are going to college, let's say a couple of years, it's a good time to take it out, the money. Be conservative that portion. Your portion, if you are close to retirement, definitely don't time the market. Just become more conservative. You want to preserve the capital because it's a good time to do so. But if you're young, you have a long time to go, don't need the money. Our recommendation, short-term market will be a little volatile, but as long as you have a timer patient, we are, our outlook is very positive with the market. It should go higher.
Okay, wonderful. Thanks. A little bit basic question that came up was, again, for the starters, is what is the difference between a stock, a mutual fund, index fund, and ETF? I think stock, everyone knows. You can go and buy the stocks, but I think the key question was how does a mutual fund differ from an index fund from an ETF? Because I think some people take everything under the one umbrella as a fund.
Yeah. So stock, obviously, everyone knows, like, Apple, Google, the Zoom, we are using Zoom stock. So now mutual funds is a basket of stock. Like you can buy, I mean, you can see in the screen left side, The different type of mutual fund, like you want to buy large company, there's a large company mutual fund, so basket of stock. And the difference between mutual funds and ETF or index fund is there's another guy sitting in mutual fund who's managing just like me. So we manage your money plus mutual fund. There's another guy who manage your money as well. It's called active management. And the fees in mutual funds are typically higher. You pay our fee. So let's say, for example, Dr. Hasib, I told you our fee is 1%, right?
Right.
Uh, if you buy a mutual fund, there's a separate fee. It's called expense ratio. That's like 0.5% on top of it. So total fee is usually 0.5%. We see 1.5%. So that's mutual fund. It's an active management. Index funds and ETF, these are new things for the last 10, 15 years becoming popular. Index fund is a mirror of an index. What I mean by mirror, let's say you think gold will go high, oil will go high. Rather buying one oil stock like ExxonMobil or ConocoPhillips, you can buy the whole index of the oil. If oil goes up, the index will go up. If oil goes down, the index will go down. So that's called index. What happened with index, you cannot buy sell instantaneously. You have to wait until the end of the day to sell it. People come up with the idea, hey, you have mutual fund, you have index fund. Do you have something that works like an index fund, but I can buy sell very quickly? That's called ETF, exchange traded fund. That's number 3. ETF, similar to index funds, there's no active management there. You just mirror a particular index and you can buy sell like stock any given time. The way things are going, because AI and everything, we believe in the next few years, all will be index fund and ETF. Mutual fund will be slowly fade away. So that's the future, looks like it. But yes, these are the 3 differences, including stock, then 4, stock, mutual fund, index, and ETFs. These are the 4 things when you get into the market, you will see all the time.
But index will be just for a certain segment. Like if you're saying, hey, this is the oil segment or the gold or the food, but you cannot combine in the index fund multiple sectors.
Right. So, but there's an index fund for the whole market as well. What I'm saying, that index fund for S&P 500, do you have it? Yeah, we do have it. Market, they have it. What is S&P 500? Some people ask. I mean, if you see the comparison index, I'm hovering my mouse. So
Right.
there's index funds for pretty much literally everything. Do you have an index fund S&P 500 stocks? Yeah, we mirror it. Do you have a 400 index funds? Yeah, we mirror it. And then there's an index funds for particular sector as well. ETF is similar to index funds, but it's just like more electronically traded. That's the difference mainly.
Oh, okay. So let's say if someone from here has asked that hey, I want to invest $50,000, what would, if you had $50,000 that you really want to invest right now, how would you proceed for that, given
Yeah,
the timing and given the landscape of what we have?
yeah. So we highly recommend. So today's session, is something to do it yourself. We highly recommend, if you really want to not worry about financial advisor, buy SPY. S for Sam, P for Peter, Y for yellow. It's a ETF or index funds for the whole Standard and Poor. If you have a long time horizon in SPY, the reason is because our experience has been that financial advisor, just like me, or any other financial advisor, hedge fund people, unable to beat the market. I mean, you can read more about this efficient market theory. And if you talk to Warren Buffett and anyone, they will all tell you no one can beat the market, including myself, Syed Nishat. Our experience has been long-term market goes high. And if you think logically, Dr. Haseeb, that SPY or index fund, it is diversified already for you. Is underneath it, you have thousands of stocks. So some people say, hey, SPY go for bankruptcy, my money is gone. Okay, if your SPY goes for bankruptcy, your house will go bankrupt too. So, I mean, it is not logical. I think SPY is diversified. I think within index fund, you can diversify more if you want to. But if you have a long time horizon, we believe you should not buy individual stock, retail investors. You don't have to take all this risk. Just buy ETF. In the long run, it will go higher.
Excellent. But then a question that's I just got is, if I buy SPY, then how does Sharia compliance come into perspective? Because some of these stocks in the SPY are non-Sharia compliant.
Yeah, so Sharia compliance, I believe this is, people always ask a question, how do I, deal with it? So if you really want to obviously go for Sharia compliance, I mean, there's some This is through Amana Fund. Everyone is welcome to take a look. FCNA, which is FIC Council of North America, they come up with guideline simplify for you, like interest, banking and insurance, gambling, pork, alcohol, tobacco. These are the things to avoid it. Now, after you're avoiding it, it is still a mixed bag. So what Amana did, or FIC Council of North America, they come up with 3 additional criteria. Because in America, it is impossible to be 100% Sharia compliance. Like it or not, that's the fact. And because the company always changing, internal investment changing. So if you find out that up to 5% of the company coming from the haram source, according to it's written right there, it's okay. Up to 5%
Right.
it's okay. Number two, if you buy a company that has more than 33% debt, avoid it. Those kind of company, if you really want to choose it. And number three, if a company have no assets, all is account receivable, 45% account receivables, no assets at all, avoid it. But the most important thing in our opinion is, and the Islamic principle are keep changing, to be honest with you. You know, my father always used to say, plain blanket, stock market haram. My
Right.
father's right away. But you know, things are changing nowadays. People are coming in, and we see Wahid investment, for example, coming into different type of ETFs. And with time, I think Islamic investment will become more mature. So I believe as long as you can avoid riba, interest, I think should be okay. You can. So, for example, you know, there's something called QQQ. It's an index fund. You can just buy the ETF QQQ if you want to buy, you know, a more aggressive technology company, and these are all tech. We don't see much of an interest in it. One option could be if you just want to do it yourself, buy some Amana fund and buy some QQQ. Leave it there for long term. Don't time the market. I think in the long run, you should be ahead of the game.
Okay. So basically, these are all passive investments, right? So if everyone was going to do passive investments, what was the role of the financial advisors? Means, do you think then there's a value in that, or like, why should we even use a financial advisor?
You don't have to. And that's why we're here to tell you
Yeah.
you don't have to use financial advisor,
Right.
but you use financial advisor for other services besides just investment.
Mm.
We just want to be very open about it because if you take a look at the statistic that I received on in my screen, those people who have used financial advisor and bought mutual funds, if you take a look, left hand side is the mutual funds,
Right.
and middle people just bought the index fund. There's no financial advisor. They just bought SPY. I'm giving an example. Take a look. This is the statistic for 10 years. 92% they underperform the S&P. 92% of the time they cannot beat the market. So that's like an 8% people who beat the market. Like I'm sure you have heard about Kathy Wood and all these people. They are usually one leg pony. What I mean by one leg pony, they beat the market 1 or 2 times, but after that, for the last 2, 3 years, if you see Kathy Wood severely underperforming the market. So we are yet to see like a wizard who consistently beat the market. 1 or 2 times we have seen it. So the answer is that if just an investment, I don't see any value of a financial advisor. The value of a financial advisor comes in, like, for example, in our situation, you're looking for more than investment management. Okay, Sayed, I need to create will, trust. Okay, we can help you. I need to open up a 529 for my children. I don't want to do paperwork. Can you do it? Yeah, I'll do it. I have like a rollover 401k. Yes. I have a large asset. I don't want to put everything into this one index funds. I have a high net worth. We would like to see your net worth more than 1 million. Okay, magic. What's the magic number? More than 1 million to justify to pay all the fee to have a concierge service. You want to outsource everything and have a peace of mind. So you can go by your day-to-day life and someone is taking care of your investment, like the way we go to a physician. So it's almost an analogy we use. So if you just get a simple headache, take Tylenol. But you know what? If you like keep getting headache, it's a good time to go to a doctor. So similar situation, what I was suggesting that if it's a simple, straightforward investment you're looking for, uh, and you have only like 50, 100 to invest, just buy this index fund. I believe in a long time you're good to go. But if you're looking for additional services, like I mentioned, this is where it justified to pay the fee for a financial advisor. I hope it makes sense.
Yeah, yeah, no, no, absolutely. Because I think what you have on your screen is very important portion of when we talk about investment planning. Everyone thinks about, oh, retirement. That's what they think about. And then, oh, how do I get my person to grow those funds. But as you said, you can put it in. Now, most of our group, we have in Azad and Adjex. That's one of the funds. SPUS, the Wahed funds, and the Amanex, AMANX. So most of our folks have in that. And alhamdulillah, they have been growing constantly. And you're right. And those who have kind of played in the individual stocks didn't do good.
Yeah.
But when you went with those, the ETF, the index funds, they really profited on that. So when we look at long-term care, can you touch, the question is long-term care, is this the one that we talk about after a certain age, or if someone gets disabled, then they leave the job and the expenses for someone to come to their home and take care of them? Is that what that encompasses? Can you elaborate a little bit more on the importance? Because really, I think our group, yeah, we have been exposed to a lot of stocks and the ETFs and the index funds, but this area of estate planning, asset protection, sometimes in residency they come and talk about it a little bit, but definitely on the long-term care and disability, can you just highlight a little bit, why is it important? What are the costs that are involved if somebody really becomes disabled and needs long-term care?
Yeah, I think long-term care is important, but the question basically becomes, what age should I get long-term care? People ask all the time. And do I need a long-term care? How do I make a justification? So the age is, we would like to see your age is over 50, ideally. Because what happened that, if you are, just in case, become disabled, before 50, let's say 40, the chances, that means something major catastrophe happen in your life, and chances of death is more at that time. So that's why the rule of thumb is over 50, you should consider getting a long-term care, number one. And long-term care means when you're bedridden, the nurses come and take care of you. So long-term care, the age is over 50. Uh, uh, when should I make a determination I should take a long-term care? If the way the financial plan you create, if the projection looks like at the age of 66, your net worth will be below 6 million. Again, if you sit down with a financial advisor, they do a projection, looks like when you retire at the age of 66, your net worth will be below 66 million, below 6 million, sorry, then you should go for a long-term care. If your net worth is more than 6 million, you do not need a long-term care in America. All right, so that's the number we are looking for. How much is the cost? Usually at the age of 50, the long-term care cost about $5,500 to $6,000 per year for a 5 years timeline horizon, but we can run a quote for you and email it to you.
Okay, wonderful, thanks. I have Dr. Ehtisham. He has, Ehtisham, can you unmute yourself and ask if you don't mind? I can ask also if you want, if you prefer.
No, I just had a comment.
Yeah.
Since I work in with Blue Cross Blue Shield, I know that. Just wanted to highlight that most commercial insurances do not cover long-term care. So I get that question a lot. Let's say a patient stays in an LTAC and goes into custodial care, right? So custodial or long-term care, maybe in a skilled nursing facility, you have to have a separate insurance for that. Your commercial insurance or even Medicare does not cover for that. Maybe Medicare covers for little time, but you have to buy it separately. So it's just like buying disability insurance separately. So something to highly consider. So just a comment for the panel. Thank you.
Oh,
Yeah,
wonderful.
I agree that after the age of 50, definitely you should sit down with your financial advisor and try to consider get some long-term care if your net worth is not substantial enough. Yes.
Okay. And so Ehtisham, just a question for him. So what kind of insurance? So the routine insurance that we get from job that just covers sickness and hospitalization, surgeries, medications, and things like that, right? But let's
Correct.
say somebody gets a bleed, intracranial bleed, they end up with a stroke, they are bedridden. Now they need long-term care. What happens?
Yeah. Sorry,
Yeah.
sorry, go ahead.
So in that situation, typically what happens is, they go into various stages of post-acute hospitalization, right? So they may, from acute hospital, they may go to an LTAC, which is long-term acute care hospital. So that if you have an employer-sponsored plan, you are still covered under that. But in the LTAC, once you're admitted, let's say we typically review for 30 days stay at a time. And within 30 days, we see if you're showing improvement. And if you're not showing improvement, and if your care is considered to be custodial, that means it's just maintenance care. So it's just prolonging your life, but there is no, you're not improving. so the insurance company is not gonna continue to pay for your services. So at that time, you know, based on the review of the medical documentation, the insurance company will issue a denial for further payments of the LTAC. And then after that, you may have to, be transferred to a skilled nursing facility, a slightly lower level of care,
Right.
and continue your care under custodial care. So some state Medicaid insurances cover that, but if somebody has long-term care insurance, that covers that. But your commercial employer-sponsored plan will not cover that.
Mm-hmm. Now, but before that happens, let's say the person owns a house and others, then would the government Medicare say, hey, you already have so much property, you need to liquidate that, and then we will pay after that if you have nothing remaining?
So yes, so because if you're applying for Medicaid, right? Because Medicare does cover that, they look into your finances, right? So if
Right.
you have significant, account balances and
Right.
assets, you won't get Medicaid.
Medicaid.
So Medicaid, so you won't get it. So you will have to pay out of pocket for
Okay, so
that.
this is the question for Mr. Nishat. So in this situation, how does estate planning help? Because that person will have a family and they need those assets there, right? So they cannot liquidate for his health or her health. So how would it be like if it's under a certain estate or a trust? Does it then be immune to the Medicare or Medicaid looking into that and still qualify that person for Medicaid while your assets are protected?
No, so basically, the question is that in order to qualify Medicaid, how does it work? Typically, primary house doesn't count, but then the rest of the asset does count for Medicaid purpose. If your situation does dire like this, I mean, it's to be honest with you, it is impossible to create like a plan for someone, let's say 40 years old, and somehow need Medicaid. It is virtually impossible. Typically, what happened that if you are bedridden at the time, you're supposed to have disability through work, though. Or you should buy a disability outside because you are not working for more than 3 months, and the disability should kick in. And the disability pay about 10,000 or up to 70% of your income, and is tax free. And you can use the money to pay for whatever coverage that you need, ideally. Now, the long-term care you're talking about to get coverage for that, you will, if you're a physician, we're talking about today's audience, I'm assuming is mostly physician, you will have assets more than the threshold of Medicaid. It is virtually impossible to do so. There are some planning people call Medicaid trust. Just to let you know, what happened that you can put any assets outside your house into the Medicaid trust. After 5 years or 60 months, those assets do not count towards Medicaid. So again, those are very hard to do planning for young people. So that's why, as a financial advisor, our recommendation that we cannot make a planning for someone Medicaid or someone young age need long-term care. Disability should kick in. That should be good enough. Chances of death at this young age, if you're bedridden for 5 years, are very high. So over 50, that's why the rule of thumb is to think about long-term care. That's what our training has been.
Excellent, excellent. Thank you. Yeah, no, we have about 37 participants on this call, and the range, honestly, is I would say the max 55 probably, and the youngest should be maybe have somebody in 30s.
Yeah, so at the age of 55, I mean, in a dollar point of view, I'm just saying it, if your net worth is 4 million, that means projection is it will become 6 million. So I mean, do the math. I mean, if your net worth is 6 million at the age of 66, if you take 4%, is $240,000 per year, you will have income coming in somehow. And this income should be enough even if you like at that time bedridden to take care of it. But what Dr. Ateeq was saying is very important as well. If your net worth is low enough, then obviously you should definitely we recommend to have a supplemental long-term care. Most of our non-physician clients who are net worths are low, we do recommend to get long-term care.
Okay, wonderful, wonderful.
Yeah.
Now, in terms of passive management and diversification, that's one big thing we always talk about. Sometimes, there's money moving from one sector to another sector. So diversification in stocks, diversification in sectors, diversification even in the stocks, some gold, some in assets, some in crypto. What's your take and suggestion? Like, how do I go around if I need to invest again? I say, let's say I want to do 100,000 now. How should I divide that money in?
Yeah, I think the first thing first, the audience over here who are not too familiar, first thing first, just understand what your risk tolerance is, because there are two things we're looking for. Young, even some people who are young age, uh, they are not risk averse actually. They don't want to take whatever the market gave. They don't want to take any risk whatsoever. So if you cannot take risk, that means that you are moderate or conservative. That means 50% should be some sort of fixed income or cash, and the 50% you can invest. Growth means 20% you basically should be into sitting in cash, and the 80% you should be invested. And 100% aggressive means, like someone mentioned, I'm young, it should be 100% equity investment. So there's no magic formula there, just four type of investment: conservative, moderate, growth, aggressive growth. You take a look at the chart, you say, okay, I can take some risk. I can, afford to, if the market goes down, I can hold on to it. Nothing to worry about. I don't get scared. Growth is the way to go. Once you make a determination, this allocation like 80-20, 50-50, 60-40, then you decide where should I invest the money. And I know this chart, people do get confused sometimes, but it is recorded. Audience can take a picture of it and do it few times themselves. I refuse to believe that physicians, you went to college for so long, you won't be able to get it. Take a picture, do it few times yourself. You should be able to figure this out. So for example, if you are, this is an example of a market which is like 80-20. That means you are a growth allocation. So what you do, 20%, I'm hovering my mouse, you sit in some sort of cash if you're Islamic. If you are okay but non-Islamic, you can buy bonds. Bonds are basically variable interest, but the principal is secure most of the time. Then you can buy large cap like SPY 25%. I'm hovering my mouse. You can buy mid cap. Mid cap means company is a little bit smaller than large cap, 10%. Small cap are very small company, 5%. And these are the symbols written there for you. SPY for large cap, mid cap VO, VB is for small cap. This is the technology company, like everyone is talking about AI and all of it. So you can buy QQQ. Underneath it, you have Microsoft, Google, Amazon in it. You can buy 25% in it. International, you cannot avoid international. You have to buy some of it. So emerging market, buy VWO 7%. And Europe, I think, is good to have some exposure into Europe. You can buy European ETF, which is VGK. So if I add all of it, I get about 100% of my whole allocation. So again, SPY, VO, VB, QQQ, VWO, VGK, and 20% sit in cash. These are a good prototype for you guys to just take a look, take a picture, just research about this particular ETFs. How does it operate? And there's so many ETFs like this. And these are Vanguards, a lot of them. Vanguard's supposed to be very cheap. So if you want to get started, what you can do, you can kind of first go back to the previous slide here, understand what is your objective and how much risk you can take. By looking at it, can create an allocation like this. Every 3 months, the allocation changes. You bring it down to this allocation. You sell some, buy some within the ETF, and just leave it there. In this way, you don't have to worry about using financial advisor. You can do it yourself, and the cost is literally very low.
Okay, wonderful, wonderful. Thank you. That's good. So, but we are still diversifying ourselves in the stock market, right?
You are.
Not the gold ETFs, not in cryptos, not in the other areas.
No, you are diversifying within the stock market, correct?
Right. But if someone wants to do heavy metals, then they can just buy gold ETFs you suggest, or like what is your take on that?
Yeah, if someone wants to buy gold ETF, you can buy GLD. That's up to 2 to 3% of the portfolio. One thing you don't want to do, put too much into one ETF, because like gold ETF, you put 10% and a gold goes down, the portfolio goes down a lot.
Right.
So, and like, for example, a lot of nowadays people are buying a lot of semiconductor ETF, my clients, putting heavy money in it. Because they believe AVGO or company like NVIDIA will shoot up. I get it, but you cannot put like 20% into one ETF. You just have to buy big blue chip company ETF first. These are the foundation. Once you create a foundation, the money you have it, those you can play with it at your discretion.
Oh, okay. Another question was, again, in the interest of time, I want to keep moving. Why $6 million and above you need to, have the one below 6 million? Why don't we need that? Why, how did you come up with the number of 6 million?
Yeah, that's the rule of thumb for financial advisors. What we are saying that at the age of 66, so 6 million, if you do the math, 4%. So rule of thumb is 4% you can withdraw during retirement, whatever your assets are. Rule of thumb is 4% you can withdraw during retirement, whatever the assets. And the retirement age is 66. So if you have a $6 million invested for your retirement, 4% of 6 million is $240,000 per year.
Right.
So 240,000, if you divide by 12, is about $20,000 per month before taxes. In America, $10,000 to $12,000 is enough to have a good life, and everything should be paid off by then. So that's why the rule of thumb is that if you have 6 million and over, long-term care, at that time, life insurance doesn't add too much of a value because everything should be taken care of it for you at that time. But again, if your net worth is below that, and long-term care, always good to have it, but it's not a must at that time to have it because your net worth is sustainable, self-sustainable. And that's what we do as a financial advisor to build up our client to go to that level if it's possible.
Oh, okay, wonderful. That's good. Okay, thanks. Now, in regards to selecting a financial advisor, so I have had, like I would say, in the past 10 years, 3 or 4 financial advisors contact me. What's the best way to select someone and say, hey, this is the guy I want to go with? Because everyone you meet, you feel that they're genuine. How do I identify the right person for me versus somebody who's a fraud or who's not the right person?
Yeah, I think the first is there's a website, public information. Like for example, if I have to, Dr. Haseeb, Google you, I go to American Board, check out your credentials. If any sue lawsuit about you, I do it all the time. Similarly, for financial advisor, there's a website called FINRA, FINRA.
Yeah.
You can FINRA.org, O-R-G. And you can type Syed Nishat there, my name, first name, last name, and hit search. All the history comes in. If you see, like, it's not uncommon for financial advisor to have 1 or 2 complaint. It's okay. I'll take it. But if a financial advisor, like suddenly you see 10 complaint, I mean, I would be worried. I mean, something is off about this guy. I would be shy away. Usually if a complaint comes in, it goes to FINRA. So make sure, go to FINRA, check out the record. Number 2, look for credentials. Hey, by the way, are you a fiduciary? That's the second question to ask. If the guy say, no, I'm a stockbroker, I have my own product like a mutual fund, I should be careful because the guy usually selling their own mutual funds or something. But if the guy is a true fiduciary, like you are a fiduciary as a physician, that means it gives some good credential. So make sure you ask the question. If the guy have the Series 66 license and everything, they're supposed to call themselves a fiduciary, otherwise they can't. So just ask him, are you a fiduciary? Are you fee only? That's another thing to ask for. So something called fee-based, but fee only. Fee only means you only charge asset under management and that's it. You're not getting paid underneath from anywhere. Fee-based means you're charging asset-based, plus you're getting paid somewhere else. So I think these are the 3 questions, FINRA, fiduciary, and if you are fee only versus fee based, it will give you some good indication. And you can nowadays, Google is there, so you can Google this guy. If a bad review should pop up.
Right. So I think the key thing is the fiduciary part. Etisham, you had a question? Right.
Yes,
Yes,
you
sir.
can. Hello?
Yeah.
Yes. So this is regarding mutual funds, employer managed 401k, self-managed 401k within an employer. Can we moving funds from aggressive funds? I'll give you example. Right now, I have a fund with Jennison, PGIM, and it's giving good returns. The market is going up. But if I see, these are really aggressive Nasdaq heavy funds. So if I see market corrections, these can drop significantly. So moving funds from aggressive to conservative with market corrections, and then moving again from conservative to more aggressive with market uptrends. Is that a strategy that is recommended to do within 401k self-managed mutual funds?
Yeah, so I think some people do that. If you believe the market is fairly high, you can, and if you're close to retirement, what I was saying, then definitely it may be a good idea to take some money off and become conservative. But one thing we kind of recommend physicians, my clients, not to do market timing. like, buy, sell, buy, sell, buy, sell, or like, what, sell it today. Like a few of my clients, like, when COVID happened, a lot of my clients panicked, sold everything. It's not like sell a little bit, sold everything. And during COVID time, if you see the mass market shoot up, because market is forward looking. So what you don't want to do, 100% time the market. Market timing doesn't work. But taking some profit out, I think is prudent. Get into a sector which is will perform well. That might be a good idea. For example, now technology is up a lot. It might be a good idea. I'm giving an idea to take some money off from technology and getting into dividend paying, because utility this year went up almost 17% this year, and utility will keep going higher. A company like Coca-Cola, those company will keep going higher dividend paying. So maybe a good idea to take some money out from technology and get into those sector. It may not be a bad idea. People do it all the time.
Excellent, excellent. Yeah.
And then, yeah, I heard one of your Mr. Khalid, Mr. Zaman
Yes.
speaking, and he was also saying about investing in electrical stocks or energy generating stocks, because with the AI, it's going to use a lot of energy, and these are dividend paying stocks. So tying that in, do you also agree with that?
Yes,
And
I do agree with it that if you don't have the exposure though into the sector, definitely EV sector should perform well. Uh, and the only thing is that Tesla, be careful, just buying the stock because of Elon Musk compensation and everything. We got to be a little bit careful, but those sectors are not a bad idea. Like if you want to buy stock, we always buy not more than 1% of one stock, 1% or 2% of a portfolio in one stock. So the problem becomes, Dr. Etisam or Dr. Haseeb, that physician buy too much of one stock, like 10% we see they put it into one stock.
Absolutely right.
As long as if you don't do those kind of stuff, you're okay. But it's like a fat finger button. We see it like WhatsApp group. They keep chatting. Hey, like my wife, she hates what I do, but she was talking about a few days ago that hey, did you buy AVGO? I said, what are you talking about? So AVGO, the stock went up. I said, why do you think it's going to go up? Well, because it's going up. So I'm thinking this kind of illogical discussion is there all the time. That is going to go up because it's going up. So as long as you didn't buy it because of that, I think it's good to go. If you have a long time horizon, I think you're fine.
Perfect. I think the key take-home point over there is that touched my heart is make sure you do not have more than 1% in a stock. Means
Correct.
And it is to be to the point that if that company closes, it should not shake your portfolio.
Correct. Absolutely. That's the most important thing.
Right, because we tend to say, oh, you know what, it's $10, and tomorrow if it becomes $15, then I make $5 per. Let me buy 5,000 of those shares.
Correct.
And that's where the rug will get pulled, and then you kind of go in the red.
Absolutely.
So making sure, again, staying diversified. Again, just to summarize what we talked about, is staying diversified is going to be very, very important, and making sure that you don't invest more than 1% in one stock. And also we talked about passive one was just get an index fund or an ETF is preferred, would be a good way to do it. Importance of we talked about the long-term care. A couple more questions and we can end. In estate planning, that's one thing that really can you explain to us, because we are not very experienced with that area. The question was, what are the mistakes that we should avoid in estate planning? Like, who do I give? Can I assign my wife as everyone she gets it automatically, or do I have to name it in my will? We need to get some words of wisdom from you.
Yeah, a couple of this thing, I think this is 9 out of 10 times our experience has been when we talked about the physician, 9 out of 10 times they haven't done estate planning. So just make sure you have a basic will, power of attorney, health proxy. I think these are 3 things are very important. And we believe that once you have children, it's not your age. Once you have children, have a couple of properties, try to get a revocable trust as well. That's very important. When you draft the trust, there are 3 major mistakes we see it, and I highly recommend talk to the attorney. So number 1, we see it on the will. Dr. Haseeb, they say that, okay, if I husband wife both dies, I want to give it directly under the name of my children.
Right.
So but by the way, you're giving under the name of the children directly, and let's say the children become older and get married and commingle the money with the spouse and get into divorce, the asset becomes half. So we always recommend don't give the money directly under their individual name. We recommend you put a clause into the trust that the children will open their own trust and transfer money out. That's extremely important, okay? So again, don't give it to an individual name. You put a mandatory provision there into the will and trust. They will create their own trust and transfer money out, number one. Number two, we see people that are physician create will and trust, but they don't fund it. What I mean by funding it, if you're creating, let's say, a trust, the house should be moved under the name of the trust. The retirement account beneficiary should be the trust. The brokerage account should be the trust. If you don't move it, and if you pass away, it goes through probate. So no point. So make sure you go to an attorney, transfer everything under the name of the trust as well. And number three, not updating it. Like physicians move job all the time from, especially young physician like you, from Virginia to California to New York. If you're moving, you created a trust for the particular state. I think, it's you're a different state. You just have to update the provision of that particular states as well. So these are the three things we recommend that physicians make mistakes all the time, and make sure that physicians have a trust setup as well, not just a will, because trust avoid divorce protection for the children and bankruptcy and creditor protection for the children as well. So these are just few pointers. Make sure create a will, power of attorney, help proxy, create a revocable trust, put the provision I spoke about, and make sure you fund the trust as well. That's very important.
Anyone has any questions on the trust? Because this is a very important. So I have, because we made a trust, but I think yeah, he just has the kids. So that's a very important point. Is let's say tomorrow if there's a divorce, then what happens? Like that gets have. Also, I want to ask you the tax. So let's say the couple dies, and now the money is going to come to the kids. Do they have to pay taxes on the house and the investments that are there? Let's say there was a trust that has everything in that.
Yeah, so a couple of things to break it down. If husband and wife both pass away, as long as the net worth is below 26 million, again, below 26 million, there's no taxes, called gift taxes, all right? Now, there's a benefit of giving the money through the trust. There's a benefit for it. The benefit is that let's say you bought Apple share of $100 and husband and wife both pass away and the stock is $200.
Right.
If husband and wife both pass away, the Apple share get a step up in basis for tax purpose if you gift it to the children through a trust. So their new cost will be 200. It's very powerful because 100 to 200, it all grew pretty much tax-free.
That's great.
So again, step up in cost basis, they get it through to the trust. Now, you ask an important question, do they have to worry about paying any taxes? And what if my net worth, what God grace, is more than 23 million? What happens at that time? Just one thing to think about, if your net worth is that high, physician is not uncommon. So as of right now, husband and wife both passed away up to 26 million, no state tax, but it is expiring next year. It's coming down to 13 million. So if your net worth is more than 13 million, if both of you pass away, there's a 40 to 50% estate tax due. So something to think about what to do if you're in that situation, because before December, I think you should sit down with the attorney and speak about it.
Okay. Okay. Wonderful. Good pointer there. The question that comes is, what if someone has created a trust? They only have a home. They don't have their investments, their retirements. Do you recommend that they should move that also into the trust?
Yeah, so what's the point of not moving it, right? Some people say that the house, they have creditor protection, or like, for example, Florida houses, people say it. If you move it into the trust, should we do it? Yeah, it's the same protection if your trusts are drafted properly, but the house avoid the probate, what I was saying.
Right.
So the whole idea of trust is avoiding probate. You've created it, why not move it? What's the point of creating a trust if you haven't moved it?
Mm-hmm. And then regarding immunity, like if there's a lawsuit, again, for everyone, means in a physician career, expect 1 to 2 lawsuits at least. At
Yeah.
least. There's no way you'll be practicing in US and will not have a lawsuit. Now the question is it going to be settled outside court? Is it going to be dismissed, or are they going to come after you? That's a whole different ballgame. But Mr. Nishat, what do you suggest? Like, how can someone how can these assets be protected? If it's in a trust, is it protected? Is it enough, or can the plaintiff come after you after your personal assets?
Yeah, so we actually had a big article written about in Medscape, and I'll be more than happy to share with your audience. So this is a completely different webinar we can do it about asset protection. So unfortunately, this revocable trust we are talking about just to avoid probate. There's no asset protection there. Just to be clarified for the audience, no asset protection whatsoever. It is just to avoid probate, like no one has to go to court. It is the asset protection for your children, divorce protection for your children. But while you are alive, there are few things you can do. For example, a lot of your DAANA members that are in Virginia. I'm just giving you a couple of pointers to give acquaintance. Virginia, they have something called joint tenants in entirety. It's a type of account. Again, joint tenants by entirety is a type of account. You can put your brokerage account there. You can put your house there. There's no cost to it. It is a state statute. As long as both spouses alive, if you get a lawsuit, the assets are protected. Just to let you know. 401k, defined benefit, assets have elements of asset protection as well. 529, that's why physicians do invest into 529s. 401k, it has elements of asset protection. And lastly, if you have too much of a liquid cash, you can sit down, we can have another one-on-one session about this, like domestic asset protection trust, irrevocable trust. That's a separate conversation to have it. You can open it up, put money there, and the assets have protection as well. So again, this trust have no asset protection, is revocable. That's a different conversation to have, but there are strategies out there to protect your asset in an event you get lawsuit.
Uh-huh. You said earlier, fund the trust. Can you explain what fund the trust means?
Yeah. So if you just create just a revocable trust is a private document. It outlines who will get what in an event anything happens to you, and the trust should be funded. What I mean by that, the house, if you have it, or if you have a brokerage account, stock market account,
Right.
You created a trust to avoid probate. But if you still, let's say it's an individual name and nothing is mentioned there, it will still go through the probate, even if you have a trust. So if the trust cannot be empty, you have to move the brokerage account under the name of the trust. So for example, I'm giving an example, Syed Nishat, my family revocable trust. I have a brokerage account. It should not be under my name. It should be under my Syed Nishat family trust. So if I pass away, there's no court, nothing whatsoever. The trust already own it. I already have funded it. So no one has to go to court, and my wife is the trustee and the children has been taken care of.
So basically, the revocable trust is just to avoid probate, which means you don't have to go through court. Automatically, it comes to the people who who are the members of that trust.
Correct.
I got that. But that does not offer asset protection. That is not like against the lawsuit and others, right?
Not
And
at all.
what did you recommend for that?
For that, I mean, first of all, my recommendation to go with something called low-hanging fruits that offered by your state. Like I just use Virginia as an example. They have something called joint tenants by entirety. Florida, they have state statute. We should take a look into that and try to organize a financial plan in such a way that those are covered without involving the attorney. Then if we see your net worth, you have a lot of liquid cash. So because remember, primary house, most states, they have elements of asset protection. 401k assets are protected. 529 assets have protection. It's just the cash portion. And the brokerage account, you don't have much of an asset protection. So we can sit down, how much is it? Is it more than $1 million? We would like to see the magic number more than $1 million outside open. We can think about irrevocable trust. We can talk about domestic asset protection trust at that time.
Okay. One more, again, this might be a little bit applicable to many of the folks here. If you have assets in India or any other country and that parents had and they passed away, how can that, if we inherit that, does it come under the inheritance laws, or is it just more foreign income and I get taxes? So how could I inherit those foreign assets from my parents and with minimum taxes?
Right. So there are two things to worry about. So basically, assets come inheritance. Remember, the 23 million is still there, right?
Yeah. Right.
You do it, you get it, nothing to worry about. But there's something called citizen versus non-US citizen. There's an issue though. So just to give an example, if I'm a non-US citizen, my wife is a non-US citizen. if I were to U.S. citizen, anything I pass away goes to my wife, unlimited, nothing to worry about, no taxes. But if I'm a non-U.S. citizen, I pass away, well, my wife inherited, there's a cap to it. Anything more than that, there's a tax due. So the first question is, are you a U.S. citizen? The answer is yes, you are. Are you getting as an inheritance? Yes, you are. So typically, if you get an asset outside, since 2014, usually the law is you should declare it. At least in your taxes, just declare. You don't have to pay taxes on it, just declare it. So, and if it's inherited, anytime more than $5,000 comes to your bank, you do have to say where the money came from. So as long as it's inheritance money, and they're usually a tax treaty between the United States and America. You may have to pay some taxes there, but as long as the paperwork is there, the money comes in, you should be okay.
5,000 is that number?
Anything more than 5,000 money comes in from overseas, you do have to explain where the money came from.
Is it at the end of the year or?
Any given time.
Oh, okay.
Yeah, from outside comes in. Sometimes you can get away with it, but typically they ask the question, the bank, where the money came from. So you have to answer it, but the money, come from inheritance, you explain it. Usually basically becomes an audit issue whenever IRS asks you, okay, you got this money overseas, where it came from, as long as you explain that I inherited the money, I paid the taxes there, you have the paper trail, you should be okay. But make sure you have a good CPA, who can prepare all the documents for you.
Oh, okay. And the same thing would apply to any foreign income, right? If you invested somewhere outside, and let's say suddenly you got $10,000 or $12,000 for that month, I would have to explain to the bank, you said, or to who?
Yeah. So income, if you have foreign income, so we're talking about foreign assets and inheritance.
Right.
A foreign income, you have to file FBAR. It's a type of form. It's a foreign bank account, FBAR. A lot of non-residents, alien, they have foreign accounts outside. They have a foreign income. You do have to file the FBAR filing.
But that'll be at the end of the year, though, right?
And that's the end of the year, correct?
Okay, cool. Okay. Well, yeah. Any other questions? So anyone, you want to unmute and please ask, go ahead before we end. I know it's 10 o'clock. Just want to be respectful of time. And other things, Mr. Nishat is also going to give his presentation, an interesting talk in our reunion in July, next month in Chicago. So please register for the event. Then on the trades event, which is going to be on Sunday morning, he will give another like 20 minutes, 30 minutes. He's going to be available there to ask questions if you have, and if you want to invest or use any of his resources, he's going to be there. So that's the contact information you can see on the screen. Those who are on the phone, it's 646-229-7943. You can always reach out to me if you need the information. I can pass it on. But you're going to send us a Medscape document, correct, Mr. Nishat?
Yes, I will. The asset protection documents, Medscape, I will email it to all the folks as well. So for asset protection, the whole idea of today's presentation, how to do it yourself. Hopefully, the more you see all the session, you'll get more educated and arm yourself to do it yourself.
Right. We look forward to meeting you in July and hearing more from you on both the days, inshallah. And then if others have more questions, write that. And if there's any interesting topic between now and July, maybe we might reach out to you if you could do another Zoom. That would really be appreciated.
Okay, very well. Really appreciate your time. Thank you.
Thank you
Dr.
so
Haseeb.
much. Everyone have a great evening. Assalamu alaikum.
Assalamu alaikum. Bye-bye.